Good morning, traders. Welcome to the Phoenix Blue morning update for Wednesday, the 9th of March. This video comes out every weekday morning before 9 a.m. UK time. Normally, one of the subjects we look to talk about are our current positions in the marketplace, how we see the day panning out and what other opportunities lie ahead. However, on a Tuesday evening we release our Trading Tuesdays video, which is intended to have had a look at the markets opening through Monday and Tuesday, and then have a more detailed look at our positions and the opportunities going forward. That video was released last night. It's currently or already on the Phoenix Blue trading channel on YouTube, so if you take a look at that, that's going to give you that information. But for that reason, I'm not going to focus on that, and I'm going to be focusing on central bank policy divergence today, simply because the next week holds so many significant announcements from central banks that play into this area. So we'll start over with the news announcements themselves and have a look at what we've got to look forward to. Well, we've got manufacturing production from the pound this morning, but what we're really interested in is the rate statement coming out of Canada at 3 p.m. this afternoon. Tonight we have the same from the Reserve Bank of New Zealand, where we've got the cash rate, the rate statement, a press conference, and even on top of that, the Governor Wheeler is speaking at 11:10. So lots of opportunity for the market to absorb ideas, thoughts for the trading of the New Zealand dollar going forward. Now, going into tomorrow, Thursday, we also have the announcement from the ECB in respect of the Euro minimum bid rate and their press conference with our old friend Mario Draghi. Again, it's going to be hugely significant. And then looking slightly further ahead than that into Wednesday next week, we have the same for the US dollar. We have the federal funds rate announcement, the FOMC statement, the FOMC press conference with Janet Yellen, but also we have the quarterly FOMC economic projections, which make this even more significant than a simple federal funds rate announcement. So we'll be looking at how that's going to play out potentially with divergence in the policies in a moment, but just a quick look at the Asian markets that we do every morning. Have a look if there's any significance of anything that's happened overnight. This is the US dollar Chinese yuan exchange rate. Well, it's still within this, what we'll call a range within this area here above the 2015 lows, so not a lot to look at there. Similarly, the Shanghai Composite, the composite of the Chinese equity markets, again hovering around the 2015 lows, so again nothing significant to report there. Over in Japan, the Nikkei 225 index, this zone here is what we'll call the 2015 lows. We've broken above those. We retested them yesterday, so we'll be looking for direction from this market in the forthcoming days. So we'll keep an eye on that. Right, over to central bank policy divergence. Well, what does this actually mean? Well, what we're doing is drawing conclusions or comparing those central banks that are looking to raise rates and in doing so strengthen their currency, and those that are looking to reduce rates to devalue their currency. Rate reduction is one way of doing it. Quantitative easing is another way of doing it, commonly known as printing money or other such exercises designed to have the same effect to devalue a currency. So which players are where in this picture? Well, on the rate rise side, there really is only one player at the moment. It's the US. The FOMC, the Federal Central Bank, had a rate rise of 0.25% in December, which was the first rise for over 7 years. They have a stated intention to have further rate rises through this year, subject to data that's released on the intervening period. Now, the data so far this year has been a little bit disappointing, so further rate rises appear to have been put on the back burner. However, of late, some of the figures have been improving, and the announcement next week will be interesting from that perspective. Now, the only other currency that's on this side of the equation with potential rate rise is the British pound. However, this at the moment is totally governed by what's been called Brexit, which is the in-out vote due in June for in-out of the EU or not. So we don't see anything happening in that marketplace prior to that vote in respect of rate rises. However, the back of the end of last year, before the vote was announced, there was potential there. So the second half of the year, this may become more relevant. On the other side, basically all the other currencies. Significant ones, the euro. The euro has low inflation, low growth, and they already have, along with all the currencies in this red box here, negative interest rates. These figures may not actually be negative, but there are elements of their interest rates that are negative, meaning that banks and institutions depositing money with the central bank effectively pay to do so. The idea being that that money will be invested or loaned to companies and individuals rather than being costing money to sit at the central bank. So the euro, as we said, very much worried about low inflation and lack of growth. Alongside this, we have the Swiss franc. Their interest is very much tied to the euro because so much of their business is done with the euro. So if we see devaluation on the euro, we're very likely to see the same on the Swissy. Over in Japan, well, Japan's been a stagnant economy for almost 20 years. They're struggling to get any sort of inflation into their economy. We've seen specific points where the Bank of Japan are effectively defending the rate from a rising above a level of about 111, because we've traded that a couple of times over the last couple of weeks. The Canadian dollar, same problems, but enhanced by the fact that the Canadian dollar is so dominated by the price of oil. Obviously, over the last year, we've seen a huge drop in the price of oil, putting massive pressure on that economy. Although in the short term, oil seems to have bounced, it still is only at about 40% of the price that it was a year, 18 months ago, with all the natural effects that has on the Canadian dollar. The Aussie and the New Zealand dollars, they are similarly in a similar position, but their issues tend to be dictated by the slowdown in China. So again, they're looking to increase business in other areas away from China, and to make their exports more competitive, they need to devalue their currencies, in order to make their products cheaper in other markets. So that summarizes where we are in individual currencies, but basically what we have, or what we're looking for, is US dollar strength against weakness in all the other currencies. If we get significant rate rises from the US dollar, then we'll start to see this divergence really strongly coming into play and giving us what we anticipate will be some beautifully trending charts. Okay, whilst we're on the subject of the dollar, we'll flick over and look at the US dollar itself and where we are with it at the moment. We've been talking about this zone this week. Within this zone, my view on the dollar is neutral. The key level for me is 97.50. If we break out above 97.50, then I'm again bullish the dollar. If we break above this level here to a new high, then we really are bullish the dollar right up to this level of $100. But if we get the rate divergence and it becomes significant because we get a number of rate rises this year, we will potentially see the dollar above these levels, which will drive all the majors into trends with dollar strength versus the weakness from the easing and potential rate reductions on the other economies. Okay, so hopefully that gives you a bit of an overview of currency divergence this morning. As I said, if you want to look more at the charts we're actually trading at the moment, if you look at Trading Tuesday video that was released last night, that information is on there in more detail than I normally have time to put on the morning updates. Usual information here about how Phoenix Blue trade. We look to trade with clean charts using price action and horizontal levels. We don't use any lagging indicators. We buy and sell with the banks. We only trade with a fundamental bias. We also analyse the commitment of traders report. This comes from the American futures market, and that gives us additional independent signals to determine our bias. We only trade with 40 pip stop losses on FX. This means you can be more profitable with a small number of winners. Now, we believe if you're already trading and you've some experience, we can significantly improve your results. And if you'd like to find out how we might do this or just have a chat with us, please email us at info@phoenixblue.co.uk. I'm Tom Colley. If you've got any questions about this morning's video, I'm at tom@phoenixblue.co.uk, and I'll happily answer any questions that have arisen from what I've talked about this morning. Okay, that brings today to a close. Thank you very much for listening, and I look forward to speaking to you again in the morning. Take care.